Three companies that I love, their stock has hit a 52-week low: Google, Visa, Nike. We're going to use our 8 pillars to check out these companies, and then our stock analyzer tool, we will input our assumptions and it'll tell us what price to pay for the stocks. So first one, Google. Guys, Google's at $98. I want you to go back at some point and watch our videos about Google. This thing hit a high of 151 in the last year. That is a 33% drop. I want everybody to remember this. In the past, when I talk to people about Google, I would literally hear people say, this stock will never fall below 120. The NASDAQ is down 30% this year. Google is down over 30% this year. No stock stays popular forever. Your job is to find companies that you love where the stock price and the value are disconnected. So if you're new to this channel, I'm Paul. I've been teaching value investing for over 10 years and 3 years on YouTube. Now, just because I have a YouTube channel does not make me an expert. It doesn't make anybody an expert. But I guarantee if you watch 4 or 5 of our videos, you will very quickly walk away having a better understanding of money and investing and realize that I have a process that looks at stocks as a business. And my goal is to find where price and value are disconnected. So let's go to our 8 pillars on Google. So this is what I love to see. We have 8 pillars here. 6 of them are green check marks. High return on invested capital, high revenue growth, high net income growth, very low debt. Look at this. They can pay off their debt with less than 1 year of their 5-year free cash flow. And the other great part is their 5-year average free cash flow is $40 billion, but last year they did $65 billion in free cash flow. That is how much? 60% greater than their average over the last 5 years. Amazing cash flow growth. Now, the areas we have an issue with are 5-year PE and 5-year price of free cash flow. These are our valuation areas. But remember, when it comes to valuation, there are 2 drivers of how much you should pay for a company based on their earnings and their cash flow. That's 1, growth level. If they have a high growth potential, you should absolutely be willing to pay more money for the company. If I had 2 companies that are exactly the same, one's going to grow 20% a year and one's going to grow 5% a year, which one would you pay more money for? It's quite obvious. Second reason to pay, high return on invested capital. This high return means that the money that's invested in the business is generating higher and higher returns as time goes on. As Charlie Munger says, you will, over a long period of time, even if you overpay for a company, if they're able to sustain this high return on invested capital, that is the return you should expect to get in the company, even if you overpay. And Joel Greenblatt uses this as his way of saying this is a high moat or high quality business. They can reinvest the capital back into the business at high rates of return. So now let's go to our stock analyst. Let's actually first go to analyst estimates. On our software here, these are the analyst estimates for the company. So going for the next 5 years, this is the earnings per share. So growth is slow, but it's still pretty ample. They're going from $5.26 per share in profit to $9 per share in profit over the next 5 years. That's pretty good growth. Not what they had in the past, but look, low to mid double-digit growth rates. Now, revenue growth. We're back in the low double digits, but look at this. They're expected to do almost $300 billion in revenue this year, and that's expected to go to $460 billion for 2026. All right, so these are just analyst estimates. I want you to keep in mind, the number of analysts here isn't every analyst out there. There are so many analysts out there. This is only our data provider. This is a good way of getting other people's opinions. Now, I don't care for analyst estimates when it comes to buy ratings, sell ratings, hold, etc. But I do like looking at these analysts because they're very intimately involved with these companies. They talk to CEOs, they talk to executives there, and they get guided on a lot of things. So again, don't necessarily include this as your absolute Bible for estimates, but I like to use these estimates as my high range. So let's go to our stock analyzer tool. Now, it's very important here that you understand the inputs I'm going to put in here. I'm going to go a little bit slower on Google to explain what I'm inputting here. But when it comes to Nike and Visa, I'm going to go a little bit faster. So please rewind this if you really need to understand this better. So the first thing I'm going to do is I'm looking at a 10-year analysis. With our software, you can do between 1 and 20 years. First line, revenue growth estimates. Okay, so these are our 1, 5, and 10-year revenue growth numbers. As you can tell here, revenue growth has actually gotten faster as time has gone on. But according to analysts, they're going to be stuck in the low double-digit range. So for my high side, I'm going to put in that estimate of 15%, okay? Now, my goal is to be more conservative as time goes on because I'm a value investor. I want a higher margin of safety. So I'm not going to assume the moon here. I'm not going to go put in some egregious numbers in here. So for the middle side, I'm actually going to do 10%. And for the low side, I'm going to be that crazy curmudgeon and go with 5%. That is low, but so many things can happen in the next 5 years. There are so many headwinds for every single company out there, not just about popularity. We're talking about global slowdown. I'm currently in London recording, and the British pound has absolutely collapsed this morning. First time it's happened in a long time. You see the euro, first time the euro relative to the dollar has been equal. So weird things do happen. Imagine all the things that have happened in the last 10 years that you did not expect. So my goal is to still be conservative. Now for profit margin. Profit margin has also gotten better in the last 10 years. They went from, the last 10-year average is 22.7. Last year they did 26%, 5 years of 23. Now remember, during booming times, profit margins are larger. During recessions, which a lot of people would argue that the next 10 years is probably going to be slower than the previous 10 years in terms of growth because we were coming off a global recession 12 or 13 years ago. So for profit margin, high side, I'm going to stick with the 23%. Middle side, though, I'm going to go with 21, and low side, I'm going to do 19. So 19 is pretty conservative because we haven't seen that level here. But the world economy is slowing as time goes on. Even if they end up in the next 10 years having a higher number at some point, there's a probable likelihood that this profit margin will decrease with economic slowdown. That is a reality of all business. It goes in cycles. Now, free cash flow margin. Guys, for a company like Google, as you can tell, it's pretty similar. So I'm just going to match this up. For me, what's important to me is to match up over long periods of time if they are pretty similar. Because over long periods of time, free cash flow and earnings should be very similar. All right, now our next two metrics are PE and price of free cash flow. We want to pick what valuation multiple that we're going to have at the end of 10 years. So two things drive this. Growth rate and return on invested capital, basically the moat. Now, this is 10 years from now. Google's already a large company as it is, and the larger and larger it gets, the harder and harder it will be to grow. My guess is that in all likelihood, the growth rates for Google are going to slow as time goes on. So as it slows, I need to get my returns in other ways, either with decreasing debt, paying out dividends, other methods, buying back shares, as opposed to looking at the growth, reinvesting it back in the company. So I'm going to actually go a little bit more aggressive than I usually do with Google. I'm going to go 14, 16, and 18 times earnings. And I'm going to mimic the exact same thing here. Now, this actually might be a little aggressive, but I'm actually okay with it considering how conservative I was on these lower two levels. And if they're able to do this 15% growth rate for the next 10 years, my guess is Google's probably a lot bigger company with a lot higher ROIC than it is today. So I'm okay paying that 18 times multiple. Now, finally, desired annual return. Guys, this is where you put in your margin of safety. So if you invest in a low-cost ETF, you're going to get 9 or 10% return. So in order to invest in an individual stock, I recommend going at a higher rate of return. Now, on the low side, you've already been conservative. So I'm okay with a company like Google putting in 12%. Now, some of you might sit there and say, well, why don't I just put in 10%? I'm okay buying Google for its worth. You very well could. But for me, my capital is limited, and I want to make sure that I invest in better opportunities. So 12%, and as time goes, as I go up the assumptions, I'm making higher assumptions that are less likely to occur. I want a higher return. So actually, maybe here, because it's Google, I'm okay with 13. And then finally, on the high side, I'm actually going to jump to 15% because these assumptions, they're going to be difficult. They're going to be very, very difficult as time goes on. Now, I'm hitting the Analyze button. There are going to be 6 numbers that pop up. Low, middle, and high based on earnings, and low, middle, and high based on free cash flow. If it's all green, that does not mean go out and buy. If it's all red, it doesn't mean ignore. If it's all green, you need to go verify this information is correct. Easy way to do it is everythingmoney.com. Join our Everything Money community. Have conversations there. Go see what other analysts are saying on the internet. Go read the bull and the bear cases. Understand the company to make sure these assumptions are correct. If it's all red, but the numbers are close, the company is currently selling for $98 a share. Let's say 90 is the number. You should not be ignoring the company. But if the number is like 40, just add it to your watch list, put it on there, and make sure that when it hits a certain price target, you go do more information. So here are the prices. Low price of 60, middle price of 90, high price of 135. So if they hit these high assumptions, you should absolutely be looking at the company today because you're going to be expecting a much higher than 15% return, because at 15%, you should be willing to pay 135. So this company actually isn't far off, $92 a share. Now I have it on my watch list at 80, and I'm probably being more conservative than I need to be, but I'm a strict value investor. My goal is to buy screaming deals, and I do think the market's overpriced. So next company, let's check out Visa. So we go to our stock search, type in Visa, go right back to it. Let's go to our 8 pillars tab for Visa. So Visa is currently at 184. The 52-week low is 182, so it's right off its 52-week low. Now, guys, this is an amazing company, but keep in mind, Visa is going to be very much reliant on the economy. People spend more money when they feel safer with their jobs and have more discretionary income. So to think that Visa won't be hurt by some sort of global slowdown, that's a little optimistic. You have to factor that in there. But again, just like Google, we have all check marks here, a much higher return on invested capital. This return on invested capital is 6% higher than Google. That's a pretty nice return. But again, we have price to free cash flow and PE ratio much different. Boy, look at Google, look at Visa buying back 28% of their shares. Guys, I don't necessarily like this, and here's why. When they're buying back their shares, they're investing the money the company has. They're investing your money as a shareholder. We don't want them investing that money on an expensive stock. And after the stock has fallen 30% or 25%, it's still a 5-year PE of 25. That could be a little expensive. So they're investing the cash of the business into a more expensive company, which is their own. Even though it's their own company, it's still not a good use of funds potentially. All right, let's go see what analysts are saying about good old Visa. Wow, look at this. Okay, so they're expecting big growth rates on the EPS. Now, a big part of that could be if it involves their buying back of shares. As they buy back more shares, this is a very common tactic amongst companies to buy back even expensive shares, because now they're splitting the earnings and the free cash flow up amongst less shares. And it's driving up this EPS, potentially. I'm not saying that's for sure happening, but it is definitely potential there. Now for revenue, lower revenue growth, which makes sense. So high single digits, low double digits. And there are about 40 analysts on these ones. Okay, so let's go to the stock analyzer tool. And like I said, I'm going to run through this a little bit faster than the other ones. Now, their revenue growth was high side, 12%. So I'm going to go 9 for middle and 6 for low. Because even though the economy might be slowing, the world's becoming a richer and richer place. And the developing nations are becoming richer and richer. For example, China, a slowdown for China is 3 or 4% GDP growth. It's still a growing economy. That's very different than the UK and the US, where an actual slowdown is actually a loss of GDP, real GDP. Now, profit margin. Guys, look at this profit margin. After taxes, they still make 50% of their revenue to the bottom line. That is one of the highest margins you're going to find out there. Because what are they doing? They're doing transactions. There's nothing to the business besides transactions. So I'm going to keep this pretty steady, I think. I'm going to go 50 on the high side, 48 in the middle, and actually I'm going to do this. 47.5 for the middle, 45 for the low. And I'm going to do, oh, wow, look at the free cash flow margin. Much different than over the long period of time, it was very similar. So let's go with 47, 49, and 51. Remember, guys, you can put whatever numbers you want in. But again, my goal is to be conservative. Now for PE, this is a brand, and the Visa brand is phenomenal. I mean, if you ask people, it's like American Express and Visa are the leaders in credit card processing. American Express more for the high end. So for Visa, I'm going to go 14, 16, and 18 again, just like Google, because this brand's the kind of brand I want. And I would love to be able to own this company, even at these low rates of return. 12. Now I'm going to do 12, 14, and 16 here. The analyzed key, stock's currently at 183, and prices are low 90s, 110, 115, and 140 or so. So it's still got a ways to go. I put it on my watch list $100, so just factor in there. Again, I'm probably being more conservative than I need to be, but that is my goal. Final company, Good old Nike. Let's look at Nike. Love Nike. So Nike stock hit a high of 180 and a low of 95, and it's currently at $97 a share. That's pretty amazing. Again, another company, people said, well, it's not going to fall that much. All right, well, guess what? That's what happens. That's the lack of joy that's in being a value investor. You're always considered wrong. When the stocks are up a ton, you're an idiot. You don't get it. You're not buying stocks. When stocks are down a ton, you're an idiot. Why are you buying that stock? It's so stupid to buy that stock. That's the peril of being a value investor. But it is what it is because it ends up making you richer, so I'm okay with that. So again, just like Visa, just like Google, we have 6 check marks, 2 reds, and I like this. Their PE and their price to free cash flow, just like Visa and Google, I almost said Voogle, are pretty much exactly the same. Now, one thing that immediately jumps out at me, revenue growth of $10.3 billion over the last 5 years, net income of $4 billion, but free cash flow of $500 million. So $4 billion growth in net income, but only $500 million in free cash flow. So let's go find out why that is. So we're going to the free cash flow statement real quick. Capital expenditures have dropped. That's interesting. Maybe there's something on the income statement I can find. So I'm looking for why there would be, interesting. Oh, that's why. So this is what we do, guys. This is why the 8 pillars are so great. So we have $6 billion last year, and 5 years ago was 1.93, a big jump. But the year before that was 4.24, and there was $4 billion here. They took a big write-off here. So it's somewhere in the book somewhere where there was a big write-off that dropped their net income big time. This is why we use the 8 pillars as the proper screening tool. It tells a story that we can then go look at. So let's go look at analyst estimates. EPS, holy cow, it's going to more than double according to these analysts. Wow, doubling in 5-6 years. That's incredible. Okay, revenue growth. Not quite doubling, but high single digits. That's pretty good. So let's go to stock analyzer tool. Now, revenue growth. Oh, let me go back to that. I already forgot what the analyst estimates for revenue growth are. Okay, high single. So this is interesting. The analyst estimates for revenue growth is high single digits. In the last 10 years, they haven't even done that. So analysts must be thinking there's a lot more potential in Nike going forward. Maybe something more about the direct, because Nike is doing a lot more direct to consumer selling. So maybe that's going to increase, definitely going to increase their profit margin. So let's go low side 3, 6, and 9. I think that's reasonable for Nike going forward. Even though if I hadn't looked at analyst expectations, I would have probably gone 2, 4, and 6 here. Profit margin. Now, they had a big profit. Like if you look at 5 and 10 year numbers, they're around 10%, very consistent with each other. And they had this last 1 year of 13%. Even though I think they can still sell more direct to consumer, I'm still going to stick around this. I'm going to do 9, 10, and 11% profit margin. And I'm going to do the exact same thing with free cash flow. 9, 10, and 11. And finally, PE and price of free cash flow. Again, great moat, great company. This is the brand out there. So I'm willing to pay a higher premium for Nike, 14, 16, and 18. And guys, in past videos, I've used 13 before. It all depends. The point is, if you have to alter these numbers slightly to make the numbers work, it's not your deal. You should look for companies that are an obvious buy based on what you see. Make whatever alterations you make to your assumptions that are minor. Minor changes in your assumptions means to me, it's kind of like, what's the example? Warren Buffett always talks about what's a good deal. He's like, listen, I don't know the exact number, but the point is, I don't know what intrinsic value is. But the point is, when a company is selling for very, very cheap, it should be obvious that I don't care what your intrinsic value is, whatever your assumptions are, it should be so obvious as to buy. And finally, for my returns, I'm going to do the exact same thing as Visa, 12, 14, and 16. I do think 16 is reasonable based on these high assumptions. Hit the analyze key, $96 a share. And guys, look, I have it on my watch list of 55, high price of 55, low price of 33, middle price of 43. A lot further to go, but it's still possible there. Thanks very much for watching our video. This is a great video, but you must watch the next video about our 8-pillar process so you can understand it in more detail. Thanks very much.